Hello, everyone. Welcome back to another episode of Signal or Noise. Charlie Bilello here. With me, as always, Peter Mallouk. And today, very special guest, Jonathan Clemens, Director of Financial Education at Creative Planning. Jonathan, welcome to Signal or Noise.
Charlie, it's great to be on your podcast. Thanks for having me.
Awesome. We got a lot to talk about, Jonathan. We're going to do 10 lessons. Peter and I have done this with Warren Buffett, Charlie Munger, a bunch of other famous investors. We're excited to have you on. I went through a lot of your columns, went through your recent book, which we'll talk about as well, trying to distill it down to 10 lessons. I'm not very good at short form, so that was very difficult. I could have probably did 100. We're going to dig into that. And then we're also going to be talking about your recent book and the Getting Going on Savings initiatives. Excited to talk about that as well. But first, I just wanted to hear, because I don't know personally, how did you and Peter connect? I know, like myself, he was a reader of yours. I was reading your columns in the Wall Street Journal growing up for years and years. How did you guys connect in the first place?
Well, first of all, Charlie, thank you for aging me. Read me growing up. Now I feel really old. But I first met Peter via email. He shot me an email, I think it was probably in 2016, and said, would I be interested in working together? And I flew out to Kansas City and went to the creative offices. Then we went out to lunch, and we talked a little bit about terms of what sort of a professional relationship would look like. And the only thing I really remember from the lunch was, Peter at some point paused and said, I don't want to make it sound like I'm offering to marry you. And I was like, well, is that even legal in Missouri? But from there, we've been doing our podcast together for 9 years now. And it's been one of the best professional relationships of my career.
Yeah, I mean, I've got to say, well, first, just for some of our audience, I have a monthly podcast with Jonathan. It's been the highlight of my month. Every month is this short podcast Jonathan and I do at the top of each month called Down the Middle. And of course, some of Jonathan's listeners might be listening to this podcast, Signal or Noise, that I do with Charlie every couple of weeks, but much longer, covers a lot of charts, a lot of topics. But, I've been a huge fan of Jonathan since I was young, and reading him in the Wall Street Journal. And he really shaped my thinking, because Jonathan, you have always had and still have a plain English way of explaining investing, keeping it simple. And it's an industry and a profession cluttered with so much noise, maybe not disinformation, but things made more complex than they need to be, usually to sell something. And you just really cut through all of that. And it really resonated for me and shaped a lot of my thinking. So the big thing for me is I had read so much Jonathan Clemens that when Jonathan opened his mouth when we first met and I heard an accent, I was stunned. I had no idea, despite all of the hours I had spent reading literally everything Jonathan had done. That was the key memory for me.
The accent, as I think I probably explained to you, was even though I was born in London and I had a lot of my education in England, I spent from ages 3 to 9 in the US, going to an American elementary school, and I really grew up speaking with an American accent. But then when I got to England and I went to boarding school, they beat it out of me. And what's left is this weird combination of the two.
Well, it's been a great relationship from then to now, and this is gonna be a great episode where we cover your wisdom from here on out. It's gonna be great.
Absolutely. I think one of the unique things about Jonathan's writing is it's very personal. You feel like you know him, even if you didn't know the accent. You feel like you know him because you bring in things about your family, your kids, just your everyday life. You work that into the columns. I don't know if you get that from people, but when they meet you, it's much more personal than what you get. So this is a big treat for me to do this. And if I'm doing a Mount Rushmore of financial writers, it's Jason Zweig, and that's pretty much it. So let's dig in. 10 lessons from Jonathan Clemens. We'll start with lesson number 1. This is a very important one. Be an optimist. And these are all quotes from Jonathan. Every morning, billions of people around the world wake up trying to figure out how they can make their life better. Buying stocks is a way to profit from that energy and dynamism. Now, Jonathan.
One of the things I emphasize to people all the time is that investing in the stock market is an asymmetrical bet. In other words, if the world continues to prosper, stocks will continue to prosper. The global economy will grow, earnings will go up, and stocks will rise to reflect it. If everything goes to hell in a handbasket, it won't matter what you own, unless you own, say, canned goods, ammo, and a very fine wine cellar. So if you're investing, it pays to be an optimist. You should be invested in the stock market because that is where the action is going to be. And if it doesn't pan out, well, it's not going to pan out for anybody else. Nobody's going to want your American Eagle coins when everything goes into the dumpster. They're not going to want your bonds. They're not going to want your cash investments. Buy stocks. If I have one piece of advice for people starting out in the financial markets, is buy a diversified portfolio of stocks and stick with it for the long haul.
So here's the challenge, Jonathan. Of course, you wrote over 1,000 columns for the Wall Street Journal, and there was writers sitting probably beside you writing about all of the bad things that were going on each and every day. So how do you keep that optimistic perspective given all of these bad things that are going on each and every year? This year, it seems quite minor so far with the tariff situation. Of course, now we have this new Israel-Iran conflict, but there's something each and every year that challenges investors, and the daily news is very, very negative. It's definitely tilted that way.
Yeah, the media definitely, tilts negative on the news, but look at that chart. Which way does it head up over time? It heads upward. You can see which way the wind is blowing. Just look at that chart. You want to be on that upward rising roller coaster. And as for the, whatever the event of the day is that's scaring people, it's in the end, the characters are different, the plot is different, the storyline is different, but essentially it is indeed the same narrative. It's like something bad is happening in the world and you ought to panic. And the answer is no, you shouldn't be panicking. You should hold tight. This is what risk looks like. And if you want to be rewarded, then you have to hang tight during those periods that seem risky.
Yeah. And Peter, this is what you often come back to, is thinking about earnings, and in the long run, earnings are all that matters. But why should people expect earnings to be higher 20 years from now, 30 years from now? If you're a long-term investor, you're feeling optimistic about the future. What gives you confidence that earnings will be higher and therefore the stock market as a whole will be higher as well?
I mean, the key is to say the stock market as a whole. So if you pick out one company and say, do you have a high degree of confidence that 30 years from now their earnings will be higher and their stock price will be up? The answer is no. You can't have a lot of certainty around one stock that's like, maybe within 10 miles of you, there might be 100 restaurants. I'm not putting all my eggs in one basket that one of those restaurants, no matter how good it is going to be doing great 30 years from now. Think about 30 years ago, all the restaurants in your neighborhood. But if you were to ask me, do I think there will be restaurants and that they will be charging more and making more 30 years from now than they are today? Well, that's an easy bet to take. And that's basically the market. Inflation's a very big part of this. We expect the price of everything that we do, from an airline ticket to a hotel room to a cheeseburger, we expect the price to be higher 10, 20, 30 years from now. That's a significant component of this on top of just the natural economic expansion.
Right. So lesson number one, be an optimist. Let's go to lesson number two, buy more when stocks drop sharply. Here's the quote: I simply take my cues from the magnitude of the market's decline, and the bigger it is, the more enthusiastic I am about buying. That may sound naive, but after decades of investing, buying aggressively during a bear market, coupled with leaning heavily towards stocks and favoring index funds, are the only ways I know to get an edge.
So, Charlie, I started writing about finance in the mid-1980s. And at the time, there were always these grumpy, wizened old men warning that the market was overvalued. PE ratios are too high, price to book value is too high, the end is nigh, small investors are stupid, they're overenthusiastic, they will pay dearly for buying at these prices. And I heard this chorus again and again over the decades, and anybody who listened to them would have left serious money on the table. What I came to realize is that we really can't forecast the direction of the stock market, certainly in the short term, based on valuations. And these, talking heads, warning of apocalypse, are leading people astray. It sounds so much more sophisticated to be pessimistic rather than optimistic. But the pessimists are the ones sitting on the sidelines while the stock market is going up. So yes, whenever the stock market goes down and the talking heads are extremely pessimistic, my gut reaction is I'm going to buy. It's a knee-jerk contrarianism. But one of the things that I've done, and I did this in 2007 to 2009, I did this in 2020, I did this in 2022, is I take my target allocation to stocks, and then when the market drops 20% plus, I buy even more than my target allocation on the bet that the market is going to eventually rebound. I don't buy aggressively on day one, but I think over rebalancing into stocks during market declines is one of the ways to improve your returns over time. It may not be for everybody. It depends on your risk tolerance and so on. But for me, it has been a very good strategy.
In all the years, Jonathan, was there any bear market that tested that kind of belief and confidence where you said, well, maybe it's not going to come back?
No. Because I'm an optimist, and because I am globally diversified. So yeah, as Peter mentioned, there are stocks that don't come back. You don't want to be pouring all your money into BlackBerry when when the share price plunges. But when the broad market plunges, pouring your money into globally diversified portfolio of stocks, it strikes me as being as reasonable as a bet as you can have.
Yeah, and Peter, right, the data really supports that in terms of if we just look at drawdowns for the S&P 500, it's hard when you're living in that big drawdown. But if you have 20 years, and a lot of people watching this have at least 20 years until retirement or even in retirement, the odds favor the bigger the decline, the more the higher the future return. And that should make sense because you're buying things on sale.
Yeah, I think one of the things people misunderstand is they go, well, the average return of stocks is 10%, or in my retirement projection, you're using 6 or 7%, and the market's now, down 30%. It's going to take me 5 years just to get back to even. And the market doesn't really work like that. What it does is when the clouds dissipate, whatever was blocking the traffic returns to normal very, very quickly. So when you see severe drops, it's usually because of a severe reason. And when that reason's alleviated, the market doesn't come back in little increments. After 9/11, everyone's cocooning. They're worried about another terrorist event. The second people calm down about that, the market rockets back. COVID, everyone's worrying about dying. As soon as we realize we're not all going to die, the market rockets back. And so most of these bear markets, they're resolved very, very quickly, relatively speaking, which is why you see the higher expected returns going forward.
Yeah, and that's not to say all-time highs are bearish. That's another myth we've dispelled over the years. You still see positive and pretty strong positive returns from there, but over 20% drawdown, if you're a long-term investor, that's a gift. The average 20-year cumulative return is over 1,000% for the S&P 500. Let's go to lesson number 3. Comfort has a cost. In the financial markets, you'll typically pay a high price for certainty. That price is paid in lower investment returns and sometimes also in greater financial hassles. Yet I see investors paying that price again and again.
So if you want financial certainty, you buy bonds, you buy cash investments, or you buy these heavily engineered products like equity indexed annuities where your downside is limited. But the problem is that the returns on these things are never going to be as good as the stock market. And in some cases, even a product that seems relatively straightforward can involve a degree of headaches that investors do not anticipate. Let's take something that had a surge of popularity within the last couple of years, Series I savings bonds. I can't tell you how many people I knew who bought Series I savings bonds thinking that,
Guilty.
This was sort of, a one-way ticket to beating inflation and, safety. And yet, they discovered that, you can't sell in the first 5 years without paying a penalty. You can't sell it all in the first 12 months. And dealing with the Treasury Direct is a nightmare. Again and again, I've heard people say that they regretted the Series I savings bonds they bought during that period. Even worse is something like equity indexed annuities, where you're locked in for 10 plus years. The commission, if you try to bail out early, can be 10% of what you invested. And while they say you're going to get the stock market's return, what you get is the stock market's return, minus the dividends, and often capped at some annual percentage each year. I mean, equity indexed annuities are a classic case of people seeking the certainty and paying a high price in return for it.
Peter, when you talk to a client, though, it's very alluring, right? That certainty. And obviously with interest rates higher, and you're saying, I could get, and we've talked about this, right? 2 years ago during that 2022 bear market, you could get 5% on your cash. People say, why should I take any risk? Stocks are going down. How do you talk to them about kind of bucketing? There is a bucket for certainty, but understanding what the cost is if you go too far in that direction.
Yeah, I think it's not just discussing expected return of stocks over bonds with clients. It's pointing out that there is uncertainty about future inflation. We don't know what's going to happen with inflation in the future, and the way you stay ahead of inflation with a portfolio is stocks. So they view like, hey, I need the certainty of this 5% because it can make sure it meets my income needs. Well, it won't meet your income needs if the price of everything goes up 15%. So how do we protect against that risk? We increase the certainty of protecting against that risk by owning stocks. And so it's really just understanding risk that then gives people the comfort to diversify into other spaces.
Absolutely. And, I'm into data and charts, and this is the chart I show people in terms of what's the opportunity cost of cash. Because in the short run, it seems like almost nothing. I can earn 4 or 5%, and maybe the stock market will be down this year, so I'll be outperforming it. And over a 1 year period, it's not going to likely cost you very much by sitting in cash. It's only the average differential is about 8% historically. You go out to 10 years, 159% differential between cash returns and S&P 500. Over 30 years, it's over 2,000%. So you compound that certainty over time, and you're leaving just a ton of money on the table. Let's go to lesson number 4, own stocks for the long run. If you need your money back within a few months, it's foolish to own stocks. But if you won't need your cash for another 10 or 20 years, it's foolish not to own stocks.
I think this is a very simple lesson. I mean, and we all know it, right? If you put your money in the stock market, and the market go down, and suddenly if you need to spend it, you got a problem. But if you have a reasonable time horizon, why would you own anything else? 30 years from now, you'll look back and say, why didn't I have more in stocks? Sure, you might not feel that tonight if the market is down on the day, but 30 years from now, you will look back and say, oh boy, if only I'd had a higher percentage of my portfolio in stocks. Think about how much better I'd be off today. And it's simple. You just need to look beyond the valleys and see the peaks in the distance. It's an emotional game in the end.
And Peter, you often talk about the analogy of the casino and how really it's very different if you're an investor, what the odds are. It's the longer your holding period, really, the more you should expect in terms of a positive outcome and a big return.
Yeah, as an investor, you're the house. On any given hand in any given year, anything can happen. Like today, the market, the odds it's going to be up or down is about 50-50. You go over a year, the odds are going to be positive 75%. And as your chart shows, you start to go out 10, 20 longer, you go to 100% really quick. You're the house. In Vegas, one hand could go either way. Play a bunch of hands, the house is going to win. You play for a decade, the house is 100% going to win, right? And so the longer you play, the more you win. It's the opposite of how most people think it works.
Yeah, and I think, Jonathan, you've written about this because people will often say, well, what if there's another Great Depression? I say, well, I'm glad you brought that up because even during the 30-year period, let's say you had bought at the peak in 1929, 30 years later, you actually did okay as a stock market investor, didn't you?
Absolutely, you did fine. Particularly, once you figure in the fact that it was a period of deflation, so that normally we're worried about inflation, but in real terms, the S&P 500 actually recovered very quickly from the 1929 crash. Also, and this is no criticism of your chart, Charlie, what we're talking here with this chart is you make a one-time investment and see where you stand, 1, 3, 5, 10, 20 years later. But most of us are investing over time. We're buying at all kinds of different prices. And that means that your odds of making money over these different time periods is substantially greater.
Great point. Yeah. If you're investing every 2 weeks into your 401k or IRA, you should almost be, Peter and I have talked about it, you're rooting for the market to go down in the short run. You want to be buying more. It's only when you're in the withdrawal stage that you want that higher price. And just to give people an idea of why you should own stocks for the long run versus just treasury bills, which there's some certainty there in terms of, it's never going to go down in value. It's only going to go up. You don't know what the interest rate's going to be. But over a 30-year period, on average, 100,000 in treasury bills bring you up to around 392,000, 100,000 in the stock market, on average 2.5 million. Let's go to lesson number 5. Your emotions are your worst enemy. Your worst enemy is often found in the mirror. Even if you don't get tripped up by Wall Street shenanigans or your brother-in-law's foolish advice, you could still end up with wretched returns if you chase hot investments or panic when the market declines.
So when I started writing my column for the Wall Street Journal in 1994, it was a period when behavioral finance, research in behavioral finance was exploding. And there were all these insights that came out about loss aversion, about overconfidence, about how recency bias and so on. And we were all, we're all subject to these things. We all, everybody, even if they're not going to act on it, has a view about where the market is going. And, this is because we are, storytelling animals who look for patterns, and we see a pattern in the market and we imagine we know something about the future. And this is one of the biggest problems as investors. We imagine we know things that are unknowable. We imagine that we know where the market is headed. We imagine we know where the economy is headed. And it simply isn't the case. And watching CNBC, reading market commentary, all of these things, are likely to poison the well. And if you read too much of this stuff and you follow it too closely, the danger is that you will act on it. If I had regrets over my investing career, one of the biggest regrets is that I looked too often. I looked at the value of my accounts too often. I paid too much attention to the market's daily movements. And all of this is just a massive waste of time. Go off and play with your kids. Do something sensible with the time that you have. Don't waste it looking at the Dow or how much your financial accounts are worth on any given day.
Absolutely. So fear and greed, right, are really your worst enemies. And if we go to fear, Peter, it's often during the biggest declines that investors make the biggest mistakes. I'm just showing a visual here of it's a hypothetical, but it's not, because this is where we saw the biggest outflows ever in terms of investors at the March 2020 lows. And if you had gotten out during that period of time and not gotten back in, your return over the last 10 years would have only been 17%, which is 1.6% annualized. And if, to Jonathan's point, you just didn't even look at your statement or look at the news at all and just stuck with it, it's been one of the better 10-year periods, 235%, 12.8% annualized.
Yeah, it's really easy to talk about staying in, and most people do stay in like thousands and thousands of days, and even into most mild bear markets. But when it gets really serious, 9/11, tech bubble, 08, 09, I don't even count COVID. It went too fast. The biggest 34%, the fastest 34% drop in history, but it didn't go on long enough to really test anybody. that's why I think it's hard for people to hang on, is when the market really is getting hit 40% plus and it goes on and on and on. Every day for hundreds and hundreds of days, it feels impotent to not do anything. It feels silly to listen to somebody say, hang on, and the next day watch it go down a little bit more. We've gone a long, long time without a bear market like that. I think we have a whole generation not equipped for the next one.
I just throw something in here. It's something that sort of dawned on me this year, watching people's reaction to this year's market turmoil, which has really been pretty modest, but to the the tariffs and what they feel is dysfunction in Washington. And what it's made me realize is that what triggers people really varies. So for some people, 9/11 was hugely triggering. For some people, COVID was hugely triggering. And I think for a lot of people, particularly, people who are Democrats, what's going on in Washington today is triggering. And I see a degree of panic is completely unjustified by what's happening in the market and by what's going on in the economy.
You combine politics and money, that just amplifies everything. It's a 1 + 1 = 5 in the hysteria column.
Yeah, it's just incredible to see the consumer confidence differentials between the Republicans and Democrats. And it flipped on a dime right after the election in terms of the Republicans became much more confident and the Democrats less confident immediately after, right? And it just, you see that time and time again. And as Peter and I have illustrated, there's almost no differential between returns between Republicans and Democrats. So just leaving politics out of your portfolio, definitely the most prudent thing. But the other emotion, Jonathan, is the greed. And for a lot of people, that can be the FOMO is just too great to ignore. And two areas I want to get your take on are IPOs, right? And the hot fund or hot investment, and ARK Innovation would be in recent years the big one. I'm just showing you the returns the last 4 years. S&P 500 up 51% if you just bought the simple SPY. IPO ETF is down 30%, ARK Innovation down 43%. How do investors avoid the temptation of the latest hot IPO or latest hot fund?
Well, I would like to say investors should just say no, but I know a lot of people find it too compelling. So if you really feel compelled to play, only play with a small portion of your portfolio. Take a couple % of your money and and invest in this nonsense. But make sure that with the other 98%, you invest in low cost, broadly diversified funds, because this stuff is going to wipe you out over the long haul.
Yeah. Let's go to lesson number 6. Own the world. Which will shine, U.S. or foreign stocks, growth or value, large or small? With the total world fund, there's no need to guess. As long as the global economy keeps growing, so will your portfolio.
So in financial theory, there's this notion, the total market portfolio. And the total market portfolio includes every security from around the world owned according to its market capitalization. So we'll set aside bonds for now and just think about the stock market, right? We know what investors believe every company in the world is worth because they voted with their dollars. They believe that Apple is worth substantially more than the rinky-dink company down the road from me. And so we look at that and we say, okay, that is probably the best starting point in terms of allocating our portfolio. Now, you can stray from that, but you should know what the total world portfolio looks like before you start, straying, before you start making bets. You shouldn't be deliberately ignoring the biggest companies in the world. Now, with my own portfolio, I have, for many, many years, owned a portfolio that looks like the global stock portfolio, with us, right now, about 40% of the money abroad. For a lot of people, that would be extremely uncomfortable. I get that. But in my mind, that is the least risky course of action because I am essentially piggybacking on the collective judgment of all investors around the world. And if they're saying that 40% of world stocks are abroad, that is how much they are worth, then that's how I'm going to allocate my money.
Do you think there's ever a time to deviate from that view where essentially have to be saying the market's wrong? Let's say in a period like 2000 at the peak of the tech bubble where growth stocks had these unbelievable valuations. Were you tempted, or did you do anything back then to say maybe I should be tilting in the other direction?
The problem, Charlie, is that people were saying you should be tilting in the other direction at the end of 1998 and the end of 1997 and the end of 1996. Yes, there are times when investors seem to go bark, screaming mad, but they can be crazy for years, right? Irrational. What was it? Fed Chairman Greenspan proclaimed irrational exuberance in 1996. We had another 4 years of the bull market after that. If you'd bailed out then, what would have happened? You'd probably got into 1999 like, wow, I've missed out on 3 years of gains. I'm going to get back in now. It would have been perfect timing.
Peter, what's your take? Is there ever a time to deviate in terms of the market portfolio?
At the turn of this last decade, BlackRock, Vanguard, and Goldman Sachs all agreed on one thing. They probably never talked to each other, but they all released reports that they expected international to do better than the U.S. that year and over the decade. And of course, what we've immediately followed was 5 years of U.S. stocks crushing international and emerging market stocks. Completely wrong. They also expected large stocks to do much worse than small stocks. Again, completely wrong. You could literally take the predictions, flip them upside down they were the complete polar opposite of where it should be. This year, we're finally seeing it happen, right? It's impossible to predict. I mean, just anybody that with conviction says one asset class is going to do better than the other, sub-asset class of the stock market in any given year, is somebody I will automatically not attribute any knowledge to. Like, I won't listen to anything that they have to say that's forward-looking.
Yeah. And Jonathan, this came from an article you wrote called Advice for the Kids. Is this when someone asks you and often you get this question, should I buy growth stocks, value stocks, large or small? And you just say, don't bother. The simplest thing is simply one fund that owns everything.
Yes, that is what I say. Because if you own everything, never means having to say you're sorry.
And Peter, what's the case that things are going to be globally, things are going to be better? There'll be continued growth in the future, innovation that's driving this total world portfolio to be higher.
I mean, two things that drive markets the most over the long run are demographics. Are there people to buy things? There's a lot of debate about the world population, but there's no debate about over 1 billion people coming out of poverty over the next 10 to 12 years. Those are going to be consumers. They're going to buy things. So that doesn't look good. It looks better than it ever has before. And then the advancements in technology and innovation, I don't think any reasonable person, no matter how pessimistic they are, don't think we're living in a time where there is going to be jaw-dropping innovation. And so you combine those two things together, it's realistic to be an optimist.
Absolutely. Let's go to lesson number 7, plan for the unexpected. While we have only one past, we face all kinds of possible futures, and it's worth asking whether those are futures we aren't even considering.
So this is obviously an important issue when it comes not just to your portfolio. You do want to have sufficient cash or short-term bonds to cover expected and unexpected spending in the years ahead. There's also, goes to issues like how much you borrow and what sort of insurance you have. I think that, when we start to ponder this issue, we're firmly in, Pascal's wager territory. And for those who don't know what Pascal's wager is, Pascal said that it was rational to believe in God. If you didn't believe in God, and you turned out to be wrong, well, the consequences are rather dire. You would spend, eternity roasting in hell. But if you did believe in God, well, what was the downside? Well, probably live a little more modestly, a little less sinfully in this life, but the cost was not huge and the potential upside was enormous. So we need to think about not just the odds of something happening, but also the consequences. It is unlikely that you will get sued, but just in case you do, you probably want to have umbrella liability insurance. You probably won't get laid off, but just in case you do, you might want to have, a little bit of cash set aside, and you should probably have a home equity line of credit that you could draw on. Steps like that. So think not just about the odds of things happening, but also think about the potential consequences.
Right. And in terms of planning, Peter, because we encourage having a plan, you should just know that there's going to be bumps along the way. It's not going to be a straight line. There's going to be changes. How do you approach this with clients? Kind of letting them know things are going to change in your life and you have to be able to adapt and change with that.
Yeah, I mean, we always talk about portfolio construction of being like, hey, let's cover the next 5 years in bonds and then equities to cover risk against inflation. Maybe private investments make sense for some people in some circumstances over long periods of time. And that's the plan today. But guess what? Things are going to change and we've got to be flexible and adjust. I want to just say that last quote by Jonathan Clemens, of all of the words I've read over all of the decades, this might surprise you, Jonathan. This is my favorite quote from you. And this is one that I think about a lot and maybe even means more than you were thinking about at the time you said it or wrote about it. And so it's my favorite by far. And I reflect on this one quite a bit.
So that's lesson number 7, plan for the unexpected. Let's go to lesson number 8, travel lightly. We end up amassing countless possessions that quickly lose their allure. Do yourself a favor, ruthlessly shed items you don't need and don't care about. I've dumped all manner of possessions over the past dozen years, and not once have I hankered to have any of them back.
When we're younger, we do tend to be very focused on acquiring possessions. And maybe it's rational because we have a lot of time ahead of us. So we have a lot of time to enjoy these possessions. But as I've grown older, my interest in acquiring possessions is de minimis. I mean, I actually get far greater pleasure from throwing things out than from acquiring them. There is in the happiness research, and this is one of the insights that has really taken hold, that it's better to spend money on experiences rather than possessions. And I certainly feel that is the case. If you have an experience, it's over and done with, and all you're left with, are the fond memories. But if you buy a possession, as important as it is, a house, a car, whatever it is, possessions hang around long enough that we have to watch them deteriorate. We have to repair them. They become a burden. That's why, if we're smart, I believe we should minimize the number of possessions we purchase.
Peter, you agree with that?
100%. Although, Jonathan, you yourself converted my thinking a little bit about some things. I mean, you pointed out, like, for some people, owning the car does truly bring joy. They love cars, and the experience or a piece of art can bring a lot of pleasure. It really reshaped my thinking around that, but I couldn't agree more. I mean, I actually get more pleasure getting stuff out of my house than having stuff come into it. And I will just tell you what I've observed from my clients, and this is a lesson I learned from them, and I've learned a lot from them, is, once people start to make some money, they start to like to invest in a whole bunch of different things, a duplex here, and I'm going to do this with my sister-in-law and this with my friend. And then they get to a certain point in their life, and their sole mission financially is to simplify things and shed things. And it becomes this decade-long project because you can't get out of a lot of things. Some things like that duplex or an art collection or your 3 older cars, or you invested in a private equity thing to help a friend and your other friend's business. You just can't snap your fingers and get out of them. And this becomes a really big project at Creative Planning, helping some of our higher net worth clients spend a decade undoing all of that stuff. So I think it applies in the real world that we started with and in the investing world as well.
Great advice. Let's go to lesson number 9, get your affairs in order. My financial focus today is on giving away money and getting my affairs in order. Make no mistake, leaving behind a well-organized life is a wonderful gift to your family.
So this is the point in the podcast where we get personal. So as both Peter and Charlie know, 13 months ago, I was given 12 months to live. So, fortunately, I'm here able to make that joke, but it is true. I was diagnosed with stage 4 cancer back in early June 2024. My outlook is still not great. In fact, before I hopped on this podcast today, I just went for my third of 10 daily total brain radiations. So if I seem a little loopy, that's because of the radiation. My current treatment plan is not working. I need a new chemo schedule, a new chemo drug. So things have been pretty rough, but I am still here. And one of the things about knowing that your life is short is that it makes really clear what your priorities should be. And my 2 priorities over the past year have been getting my financial affairs organized. And even me, who thought that I was very well organized, it's amazing how much paperwork I've thrown out over the past year. I had my tax returns from 1986 onward. Now, 1986 was when I moved back to the US from the UK. I was like, why in the world did I have my tax returns from 1986 and all supporting documentation? And the other thing I've been doing is giving away money. Strange to relate, but I will not need my retirement accounts now. I will not need all this money I've accumulated over the past 4 decades to carry me through a 30-year retirement that's not going to happen. So I've been focused on giving away money to my kids, figuring out what's the best way to disperse this money, given that Pennsylvania has an inheritance tax and so on. And in terms of giving away money, what they say is true. Giving away money is an enormous source of pleasure. If you want to make yourself happy, give money to somebody else. Volunteer. It will make you probably happier than the people you're looking to benefit.
Yeah. Peter, anything to add on that?
I obviously I've known about your prognosis from the very beginning, but every time we get an update, I'm struck by just the way you deal with it all. And for the people listening, Jonathan's been featured in the New York Times. There's a great story about his outlook and take on what he's going through, and in the Wall Street Journal as well. And his impact on you're really taking what you're going through and using it as a way to educate other people. And your grace with all of it is incredibly inspiring. I mean, from the moment you told me about it and your outlook then to the way you just described coming out of treatment minutes before this podcast, it's incredible.
I'm sure it's motivating countless people, and I'm sure you're getting messages to actually take some action. As we know, many people don't have, and you were pretty organized before this, but most people have no will. They don't have any power of attorney. Their documents are all over the place. And just hearing from you saying you made this your top priority because you didn't want to leave this burden on your family, I think was huge.
Yeah, I mean, if your family likes you at all, they're going to be in great distress after you're gone. Do you really want to make the stress even worse by handing them an estate that's completely disorganized? I mean, I've seen it so many times, and I think there's a strange psychology here, which is, if I don't get a will, I won't die. If I don't tidy up all these financial papers, I'll go on forever. I got a message for you. No, you won't go on forever. Get it organized, and you will feel, better about yourself, and your family will feel a whole lot better about you after you're gone.
Yeah, absolutely. And in terms of just the last point on that, should people try to just make a 1-page note and write something, just summarizing everything, beyond just getting the documents? Is that something that you've thought about?
Yeah, so you certainly want a list of financial accounts. You want the usernames and passwords. You want to create a roadmap to your estate. And to the extent that it's simpler, something we were just talking about, it'll be even easier for your heirs. I mean, one of the things that I've done over the past year is I've closed out various credit card accounts. For instance, if you call up and close out a credit card account, it's really easy if you're the owner. If you're gone, the credit card company might ask for a death certificate. It could be very difficult to get that account closed. So, if you've got 5 credit cards, get it down to 2. Close out 3 of them, and that way, that's 3 things your family will not have to deal with after you're gone. When my father died in 2009, I inherited a very small IRA, and I kept it, and I did the whole stretch IRA thing and so on. But as of last year, it had $6,700 in it. It was small. What would it have taken for my kids to close out that account? It would have been a royal pain. So I just went ahead, liquidated it, paid the taxes, and that was one less thing for them to deal with. So yes, simplify your finances, create a roadmap to your estate, have a list of all your accounts, usernames, passwords, get that durable power of attorney, get that healthcare power of attorney. For goodness sake, have a will. All of these things. It really doesn't take that long. You just need to put in a little bit of effort.
You know what I'll add to that, as an estate attorney who's drafted thousands and thousands of plans and unfortunately seen hundreds and hundreds of people pass and try to implement them. A lot of people go, well, I'm not going to take this one little account and move it because it's small. Well, it takes an equal amount of time for an heir to have to do that than a multi-million-dollar account. If you've got an account that has $800 in it, it's going to be a big hassle, especially if there's not a trust involved, for a beneficiary to deal with that. So you can't really look at, is it big or small? It's just, is it a whole other account, a whole other business, a whole other investment for them to deal with? Just take care of it.
Just one other thing I'll throw in there, which is, one of the things I did within a couple of days of getting my diagnosis was to sit down, with my kids and with my wife, Elaine, and talk through my estate and who's going to get what. There should be no surprises. I've said to everybody, I do not want any squabbling after I'm gone. You know exactly what you're going to get. It's all written down, and if you really want to piss me off after I'm gone, you will be arguing over this stuff. And I like to think they heard me.
Absolutely. Let's go to lesson number 10. I think it's the most important lesson. Appreciate the little things. I find my greatest joy comes from small, inexpensive daily pleasures. That first cup of coffee, exercise, friends and family, a good meal, writing and editing, smiles from strangers, the sunshine on my face. If we can keep life's less admirable emotions at bay, the world is a wonderful place.
And Charlie, even at this point, I wake up every morning and I'm grateful to be alive. And I stagger down the stairs because that's how I walk these days. And, I make that first cup of coffee and I sit down in front of my laptop and, look at, the various emails that have come in, and I correspond with people and so on. And doing these small daily things brings me great joy. The world is indeed a wonderful place. What we need to do is to be grateful for what we have, to have a sense of purpose about each day, to think the best of the people around us, not to assume that they're out to get us. There are people who are out to get us, but I would say that 90% of people have good intentions. Often those intentions are misconstrued by us, and that's how people end up in stupid arguments. But most people are good. There's enormous happiness to be had out of daily life. And, trust me, I want as many of those days as possible. And, people say, my life would be so much better if I had millions of dollars. No, it wouldn't. It wouldn't be so much better. It doesn't take very much money to have a wonderful life. You think about all the things that you really enjoy, things that you really enjoy. In all likelihood, they cost little or no money. How much does it cost to sit down and have a glass of wine with your spouse in the evening and talk about the day? That's one of my highlights of my day. And a bottle of wine costs $15. It doesn't cost a lot of money to have a really happy life.
I think what struck that's awesome, Jonathan. That's I think people should really appreciate what you're saying here. It's hard to do it, but I think what struck a lot of people in terms of the last year is people might say, "Oh, if I got this diagnosis, why doesn't he just liquidate his accounts and go traveling around the world and spend all of his money?" But instead, you're saying you're still doing the things that bring you joy and meaning, and part of that is working, writing, and editing.
Yeah, I think it's really important to have a sense of purpose, to do stuff that we find fulfilling. I mean, I have taken, some expensive trips. I've taken a couple of trips to Ireland. I've been to England. We went to Paris. I took a cruise. But while those were all fun trips, I think my greatest joy remains doing what I love to do every day. And that would include talking with you, Charlie, today and talking with Peter. I mean, this is fun. I think that all of us, or almost all of us, want to make some small difference in the world. We want to leave the world a better place than we found it. And even now, even at this late stage, I'm trying to do that. I'm trying to pay it forward. And I would encourage everybody to try to pay it forward. I mean, what's the alternative? Am I going to sit and spend the rest of my days binge watching Netflix? I mean, I get bored watching the TV after 15 minutes. I don't want to spend my time doing that. I want to spend my time engaged with the world and trying to make it a better place.
Well said. And on that point, I want to talk about the Getting Going on Savings initiative. And really, a lot of what you write about, what I write about, what Peter's written and talked about is the idea of saving early, delaying gratification, and letting really compounding do the work. So I just want to give a bonus lesson here and then talk about your new book, Give the Gift of Compounding. If you have a young person in your life, you know that one of the greatest gifts you can give is to get them started investing. If they may not have a lot of money, but they have a lot of time. If you can get someone started in the financial markets at a young age, the payoff is potentially huge. And I know that's a huge thing for you, Jonathan, and that's kind of the reason that you're putting out this book. And so tell us about this Getting Going on Savings initiative.
So a number of people who are in leadership positions or associated with the Bogleheads Forum and with the John C. Bogle Center for Financial Literacy approached me and said, we'd like to do something in your honor and your memory. And they suggested a journalism award. And I was like, the world does not need another journalism award. There are all too many journalism awards out there, And I said, almost off the cuff, what I would like to do is set up a program where we try to get people from less affluent families start in the financial markets at a young age. And I said this and, didn't really hear much about it, but what I did was I set off a whole bunch of work that had been done by people involved in the John C. Bogle Center for Financial Literacy, or who are somehow known by them. So we're talking about like Christine Benz from Morningstar. We're talking about Jason Zweig at the Wall Street Journal. These various people got together and cleared all these hurdles to making this initiative happen. They set the John C. Bogle Center up to accept nonprofit donations. And one of the other ways they raised money was by selling this book, The Best of Jonathan Clements. So I did have a hand in this. I selected the columns. I did a little bit of editing on them, but people might know the name Bill Bernstein. Bill, went through and, wrote some of the intros to the chapters. He also wrote an introduction to the book, as did Alan Roth and Jason Zweig. And this all came together, and it's now available on Amazon. And as best I gather, I'm not sure whether I'm meant to publicize this or not, but so far they've raised about $300,000 for this initiative. And the initiative will be get a test this summer in Boston. It's going to be nationwide eventually, but this summer in Boston, through the city of Boston. Kids who are part of their summer work program, some of them will be given $1,000, which would then be invested in a Roth IRA. And this will be tracked by a group of academics to see whether it pans out, whether these kids cash out the accounts, whether they let the money ride, whether they add to it. It's really an effort to see, does actually giving people money and getting them started in the financial markets, does it lead to good financial habits? And I'm optimistic that it will. I mean, I'm sure some of the kids will cash out the money right away, but I'm optimistic that at least some of the kids will see the value in putting their money into the financial market, and that these accounts will turn them into lifelong investors.
Yeah, and I got my copy right here in terms of the book, and it's a wonderful read. And what's amazing to me, Jonathan, is just how timeless the lessons in there were. You're talking about the 90s and early 2000s for most of these columns that you wrote, but they're still applicable today because the markets may change, but the behavior is the same, right?
Absolutely. And when I was at the Journal, the most torturous part of writing these columns was when my editor would come back and say, "Well, what's the news hook? How can we make this timely?" And it's like, if it was timely, it wouldn't be nearly so useful.
Absolutely. Well, Jonathan, this has been an absolute pleasure. Thank you so much for joining us on Signal or Noise with your timeless wisdom. Very much appreciated.
It's been great to be with you, Charlie, and with you too, Peter.
The best one we've done to date. Thank you both.
We'll see everyone next time on Signal or Noise. Thanks for watching.